Hi there everybody and welcome back to another stock analysis video. Today I would actually like to analyze the company CVS. Now this company, hopefully if you live in the United States, you know what this company is. I mean, you pretty much just see them at every single corner, pretty much all over the US. And even though guys, they did have earnings today before open, I am a little bit late on this. I normally like to do companies on earnings day. However, this is going to go up on Thursday and we might be able to see how these price fluctuations that we had during earnings might actually affect whether we want to buy it or not based on certain assumptions using discounted free cash flow. So with that said, let's get started with this analysis. We are going to come right into the dividend summary, guys. Dividend yield of 2.29, which ends up being 55 cents a share for an annual payout of $2.20. Payout ratio is 23.70%, which is actually really good. However, we're going to take a look at this in regards to another aspect, the 5-year average free cash flow, to see what that payout ratio is. Now, in regards to the 5-year growth rate on this dividend, it's very, very low at only 2.57%. And also the dividend growth has only been around for one consecutive year. However, if we take a look at their dividend history, we can actually see that it's not that they essentially cut it, they actually haven't. It's just that ever since 2017, from some reason, they have kept it the same at 50 cents per share, and then they just brought it up recently as of 2022 at 55 cents per share. So when it comes to dividend play, this is good, I guess you could say, in the sense that they have not cut it. However, it is not good because you want a nice consecutive increase when it comes to their dividends year over year. Ex-dividend date was April 21st, payout date was May 2nd, and they pay their dividends quarterly. Coming now to the calculator, we got the ticker symbol of CVS, market cap of $132.1 billion, PE guys of 16.9. So at the current share price of $100.57, this is telling me that with the earnings alone, this might be a pretty good decent buy. However, let's take a look at the shares outstanding, which is something that a lot of people don't tend to look at, their cash flow, and what we might actually think they will be in the next 4 years. Now, with an annual dividend of $2.20, this comes out to be almost $3 billion being paid out in dividends every single year. And surprisingly enough, guys, they still have left after this dividend is paid in their 5-year average free cash flow of almost $7.6 billion, which only comes out to be a payout ratio in regards to the free cash flow of 27.71%, pretty much lining up with the other payout ratio that we just saw, which is really, really good because they are able to continue to pay this dividend as well as increase it into the future. Now coming over here to the fundamentals, we got the net income 5 years ago of $6.6 billion to 1 year ago of almost $8 billion. That's an increase, guys, of 19%. Very, very steadily. However, the one issue that, I mean, if you guys are seeing this, it's a huge glaring issue, is that 4 years ago, they went negative in their net income, almost $600 million. What caused this? I have no idea. You would say, oh, COVID probably happened, but I mean, it doesn't make sense because when COVID happened, you would assume that pharmacies, right, were probably open and that they were also in high demand as well. And actually, we see that right here, that 2 years ago, they essentially just rocketed up, right? 4 years ago, I have no idea what caused this negative income. If you guys know, please leave it down in the comment section below. But as it stands, I see it as an outlier. Aside from that, it is still a very, very nice increase within the past 5 years. Taking a look now at the free cash flow, cash from operations less your capital expenditures, the lifeblood of the company. And this is the metric that tells us whether or not we should be buying at today's prices or we should either wait for the price to drop. So you can see right here, 5 years ago of $6.1 billion to 1 year ago of $15.7 billion. Guys, there's an increase of 159% with an average 5-year free cash flow of almost $10.5 billion. This is looking really, really good from these numbers alone. But what looks even better is the fact that every single year within the past 5 years, they have slowly been increasing it very, very consistently. And that to me is worth a million times more than if you just have like one outlier or two outliers just skewing all the numbers over, right? The fact that they went from 6.1 to 6.8 to 10.4 to 13.4 to 15.7 billion dollars every single time, that's really, really good. It's a really nice consistent increase. Next, looking at the revenue 5 years ago of 180 $144.8 billion to 1 year ago of $291 billion. That's an increase of 57.45%, and very similar to the cash flow, we see a nice steady increase within the past 5 years as well. Coming now to the total assets minus the total liabilities. Guys, if they were to liquidate all of their assets, would they be able to A, cover their liabilities, and B, how much money would they have left after doing so? As you can see right here, currently they're at $75.4 billion if they were to do so. And to their credit also, they have been above water every single time. And not only that, they have continued to increase their assets and liabilities, bringing it more and more into the positive every single year, which is really good. Actually, their total average assets is not that bad either, of $201.8 billion. Total average liabilities around $138.3 billion. Average assets minus the average liabilities, we get around $63.5 billion. Now coming over here to the shares outstanding. So far everything looks pretty good, and unfortunately this is where they tumbled down to the ground. Because unfortunately, as you guys see, they are diluting you. They are increasing the shares by a huge amount within the past 5 years. And if you guys know what shares outstanding is, it is essentially the numbers of shares out there that is available to buy. If this number keeps going up, this means that the company is diluting you as the investor. You don't want this. You want the company to be buying back shares, and by default, that increases your value of the shares that you already own because there's less shares out there. The more shares out there that there are, the less ownership of the company you have because your shares are worth now less. So as you guys can see right here, 5 years ago of a little bit more than 1 billion shares to today, guys, of 1.3 billion shares. On the 5 year, that is an increase of 30.37%. And from the previous year to the current year, this is an increase as well. We are looking at 2 years ago to 1 year ago. There's an increase of almost 1% at 0.92%. Really bad. So far the worst metric. Oh my god, I do not understand why they are increasing their shares this much. Probably to essentially increase their assets and lower down their liabilities, essentially, instead of taking on more debt. That's my only solution to this, because they clearly have not been increasing this dividend, which is essentially what companies use with their free cash flow. So, you know, they are definitely not issuing a higher dividend, as we just saw, only 1 year growth. They are probably paying down their debt, but they are certainly not buying back shares with this either. So really big red flag. And from this guys alone, this is not an attractive metric at all. And lastly, we got the cash and equivalents, and currently they have around $9.4 billion in cash and equivalents with an average cash around $6.4 billion. Now let's make some assumptions, low, medium, high, using 3 different factors: revenue growth, projected share buyback, and the required rate of return. For the revenue growth, guys, I like to use Seeking Alpha's growth tab, seeing the revenue growth year over year and the revenue growth forward, and making an assumption between those two. For the projected share buyback, I am going to use the shares outstanding graph that we just saw. And lastly, for the required rate of return, keep it flat at 10%. For my lowest assumption, I'm going to say a growth of 5%, predicted share buyback of -7. This means that they're going to continue to issue shares within the next 4 years of -7%. This comes out to be a target share price, not adjusting for debt, of $109.45. For my median assumption, let's say a growth of 7%, predicted share buyback of -5%. This comes out to be $119.54. And lastly, for my highest assumption, a growth of 9%, predicted share buyback of -3%. This comes out to be $130.44. Now let's adjust for debt. The way we do this is cash equivalents and the net debt. If they have more debt than cash, this number comes down. As you can see right here, it does come down a significant amount, around $40 or so. And if they have more cash than debt, then this number comes up. So for my lowest assumption, this comes all the way down to $71.29. For my median assumption, it is $80.62. And for my highest assumption, it is $90.75. Adding a margin of safety of 5, 10, and 15%, just because I don't want to overpay for something. The more you pay for something today, the less returns you're going to have in the future. So adding this margin of safety, for my low assumption, I would personally like to buy between $60.60 to $67.72. For my median assumption, it is $68.53 to $76.59. And for my highest assumption, it is $77.14 all the way up to $86.21. As it stands, guys, the current share price is $100.57. Now, if you just ignore all my target share prices, adjusting for debt, as well as the margin of safety, then this is a pretty good buy all across the board, right? However, this really just depends up to you, because all of these numbers are taken based off of my assumptions, essentially these three. If you change any of these numbers, you will get a change on this massively. Let's say, for example, that you think that they're going to grow at 10% and that they're actually going to start buying back shares at 1%, and you want a higher required rate of return of, like, let's say 12.5%, then this actually changes all the way up to now $104, right? And let's say that you want to keep the required rate of return at 10, well, this is now $140, right? So you're getting more returns according to these assumptions. That's why, because all of these assumptions are based off of what you guys believe is going to happen in the future, I have this calculator available for free, as well as my book value calculator as well, and a dividend tracking sheet, all for free. It's in my calculators playlist. All I'm asking for in return, guys, for these 3 free things is help me grow my channel. Hit that like, hit the subscribe, hit that bell, and of course share. We've gotten a lot of new subscribers because of that check video. I don't know why it was so popular. I really don't understand why. Usually the videos I think are going to be popular are not, and the videos that aren't going to be popular are. I don't know. But yeah, nonetheless, help me grow. 3 free things. I'm giving it away for free. Just please help me grow. We'd love to get to 1,000 subs by the end of the year. That's really all I'm asking for. Now, let's actually take a look at the dividends at the current share price. Let's say that you want to put in 1 month's income, assuming that you make $68,703, which is the average US income, into this company with the current annual dividends per share of $2.20. How much money in dividends would this company give you back annually, quarterly, and monthly? Well, this would actually buy you 56.93 shares currently, which would come out to be $125.24 annually, $31.31 quarterly, and $10.44 monthly. So as it stands, there are better ones. I mean, the one that we just did with ET, that was massive. I don't understand why that one didn't get a lot more attraction. I mean, that dividend was huge. It was in the 500s. It was massive, absolutely insane. So as it stands, when it comes to this company, you know, there are better ones out there. Not saying for you to go buy ET or anything like that, or that maybe you should just skip on this one, right? This is not financial advice. None of this is. But as it stands, when it comes to this, yeah, there are better companies out there when it comes to their dividends, if that's what you are looking for. All in all, when it comes to CVS, it's a staple, right? It's a staple company. Everybody pretty much just knows it. My one concern with all of this is, well, actually 2 concerns, is that shares outstanding is really massive. And number 2 is how many companies are actually moving towards giving out medicine, which I personally don't agree with, through online, right? I don't necessarily know how CVS would actually fare. Granted, I know CVS is more than just their pharmacies, but understand that the pharmacy side really does play a big role, right? Now, whether or not you believe that tends to be true, or that we are heading into that direction, I don't personally know. But this is something to think about. The main concern when it comes to their numbers is that shares outstanding. They're diluting you, and in my personal opinion, that is really bad if you're holding this long term. That pretty much is it for this video. Like if you like, guys. Comment, subscribe. As I said, follow me on my new tech sites, BitChute, and Rumble. All links in the description. I also have a Let's Play channel. The links are also in the description. So if you want to see me play Sonic Unleashed, which I'm currently playing through now, you guys can follow me there. With that said, peace out, and be on the lookout for the next stock analysis video.